Welcome to my exam prep episode for financing. I'm Tom, and I designed this whole series to help you pass your real estate exams, just like I've helped hundreds of my previous students. I urge you to watch my welcome and my exam insights and strategies videos for a complete overview of this whole series. You'll learn how to get the most benefit out of these topical videos. Here's a quick recap to my welcome video with some important information. Actually, we'll be in test world during my exam prep video series. By that I mean we're just going to talk about what's on the test, how it's going to show up on the test, the types of questions that might be used. My series is definitely a supplement only to your course materials from your education provider. I'm not going to reteach the course. So for that reason, I encourage you to take a lot of notes. Take a lot of notes. There'll be things that won't be on the slides, comments I'll make. The more you write down, the more likely to remember when you take the test. Time to talk about financing. So gather up your course materials from your education provider. Grab that notebook and make a lot of notes as we go through this, and keep your positive attitude with you at all times. So let's get started. We're going to start with some basic terminology about financing that will show up on the test. They're just going to want to make sure you know the basics. Points and loan origination fee. Points are charged by a lender to increase their yield on a loan. But the value of 1 point is one thing you'll be asked to compute somewhere along the way on the test. So 1 point equals 1% of the loan amount. Test alert here, loan amount, not the purchase price of the house. If the house price is $200,000 and the borrower wants to borrow $100,000, the value of 1 point is going to be $1,000, or 1% of the loan amount, not the purchase amount. Make sure you don't make that mistake on the test. The loan origination fee is simply what a lender charges to issue the loan. That's the income the lender makes by actually issuing and processing the loan. Our next testable term is loan to value. That expresses the loan percentage compared to the value of the property. If somebody wants to buy a house for $100,000 and borrow an 80% loan to value loan, then how much are they going to borrow? They're going to borrow 80% of the property purchase price, 80% of the $100,000, or $80,000. So the loan to value percentage times the value of the house is going to equal the most the lender will loan. 80% loan to value is the max in our case. Another good tip for the test that'll help you through a couple of questions is always remember that the loan to value percentage added to the down payment percentage will always equal 100% of the value. So an 80% loan to value is going to require what percentage of a down payment? 20%. 60% loan to value requires a 40% down payment. So when you talk percentages, they always add up to 100%. The next term you'll need to know for the test is PITI. Principal, interest, taxes, and insurance. That's a home buyer's entire payment, and it's broken out like you see on the screen. The debt service, paying back the loan, that's the P and I part. That's principal and interest. The T is property taxes, and 1/12 of the property taxes will be added into the monthly payment. And 1 month's worth of homeowner's insurance is the last I in PITI. So 1 month homeowner's insurance. So know the term PITI constitutes the buyer's total home payment for the month. All right, let's talk about the next two terms, lien theory versus title theory. Different states have different theories, all right? A lien theory state is a state in which mortgages are used by a borrower to secure a loan from a lender. The borrower will give the lender the mortgage, and then the lender will loan the borrower money to buy the house. In a lien theory state, the borrower has legal title. After they close, they have legal title, but the lender puts a lien on the legal title that the borrower has. So that's why it's called a lien theory state. In a title theory state, there are three people involved. There's not a mortgage, there's a deed of trust. And we'll talk about deeds of trust in a little bit. But in a deed of trust state, there's three people involved. Instead of a borrower and a lender, there's a borrower and a lender and a trustee in the middle. So when a borrower borrows money from a lender in a deed of trust state, the borrower doesn't get the deed. The deed is held by the third party, the trustee. So the trustee holds legal title. And then when that loan is paid off, then the borrower receives the deed and receives the legal title. So that's the difference between a lien theory and a title theory. Who has legal title after the loan is made? In a lien theory state, the borrower has legal title, but the lender puts a lien on the legal title. In a title theory state, the borrower doesn't get title to the property. A trustee holds the title until the loan is paid off, and then the borrower gets legal title. In lien theory states, borrowers use a mortgage to borrow money. So what do you need to know about mortgages for your test? Here's the terminology broken down. It's very important you understand all of this. A mortgage is a two-party instrument. So who's involved with a mortgage? Just the borrower and the lender. But this is where you need to start to brush up on and make sure you use your E's and O's properly. The borrower is referred to as the mortgagor. The lender is referred to as the mortgagee. Well, overall, you have this somewhere in your material, but excuse me, make this note in your book. An OR, the mortgagor, when it's OR at the end of the word, that's the person who gives the document. When there's an EE, the mortgagee, that's the person who receives the document. So the mortgagor is the borrower, and the mortgagee is the lender. And you have to know on the test, they're not going to say buyer or borrower or lender. They're going to say mortgagor or mortgagee. Now this one is particularly troublesome for a lot of people because it's used wrong in the marketplace all the time. I want to take just 30 seconds and talk about that because I don't want you to get it wrong on the exam. This term is used incorrectly in the marketplace all the time. How many times have you heard this sort of an ad? Come to ABC Lenders and get a good mortgage. Well, you're not going to a lender to get a mortgage. What are you going to the lender to get? You're going to the lender to get some money so you can buy the house. But before that lender will loan you the money, what are you as the borrower going to need to give to the lender? You're going to need to give the lender the mortgage. You're going to need to mortgage your house. You need to give the lender a mortgage. So the buyer, the borrower, gives the lender the mortgage. The lender receives the mortgage. So make sure you keep that E's and O's with respect to mortgages straight. And we said before, when I want to buy a house, I go to a lender, I give the lender the mortgage, the lender loans me money. Once the lender loans me money, I also get title to the property. So in a lien theory state, I have title to the property. But then the lender puts a lien on my title, puts a lien on my deed. So whenever I try and sell that house, somebody will notice there's a loan, I have to pay that off before I can actually sell my house. So the lender's the mortgagee, and the lender has a lien on my property. That's why it's called a lien theory state. So that's mortgages. And as I said before, deeds of trust are different. Deeds of trust are a three-party instrument. There's three people involved. We have the borrower, who is referred to as the trustor. You have the lender, who is referred to as the beneficiary of the trust. And you have the trustee that actually holds legal title until the loan is paid off. Now, the good news is, for the test, here's all you're really going to need to know. A deed of trust is a three-party instrument. A mortgage is a two-party instrument. Deeds of trust. How many words in deed of trust? Three. Three-party instrument. If you reside in a state that uses deeds of trust, you may get one or two other questions on the test about deeds of trust. So here's the terminology and the facts you need to be aware of. What happens when the loan is paid off? Well, when the loan is paid off, the borrower will receive and should record a deed of reconveyance. It's only when the borrower gets the deed of reconveyance that they actually hold legal title. Remember who had legal title before it was paid off? That's the trustee. Borrower's paid it off, trustee gives the borrower a deed of reconveyance. What would happen if the borrower defaulted on the loan in a deed of trust state? Well, foreclosure would be done by the trustee. The trustee that holds legal title would foreclose on the borrower. And then at the foreclosure sale, whoever is the high bidder would get a trustee's deed. So that's the difference they might ask you about on the test. When does a deed of reconveyance get used? It gets used when the borrower pays off the loan. Well, then when does a trustee's deed get used? A trustee's deed is used at a foreclosure sale after the borrower defaulted. The next critical document in this whole transaction is the promissory note. Promissory notes are used in mortgage and deed of trust states. They're evidence of the debt. They're basically an IOU. And there's certain elements that are essential to be in the promissory note. It has the amount owed and the terms of repayment. Promissory note is only signed by the borrower. Watch out for that on the test. It's only signed by the person borrowing the money. The lender does not sign the promissory note. Very important for the test. You could look at this slide and hopefully yourself by now could fabricate 2 or 3 or 4 test questions that would be easy to come up with on the test. All of the following things are true of a promissory note except. Well, what if it says the promissory note creates a lien? Is that true? No, it's not. The promissory note does not alone create a lien. Promissory note is not signed by the lender. Promissory note is signed by the borrower. That's how you want to look for these on the test. Some very important clauses in our transaction here. The acceleration clause. You need to know all these definitions for your test. Acceleration clause means the lender can accelerate the time to repay if the borrower's in default. The borrower doesn't make their payments on time. The lender can say, you had 30 years to repay, now you have 30 days to repay because we're calling the loan due and payable immediately. Good way to think about the acceleration clause is, what gets accelerated? What gets accelerated with the acceleration clause? And that's the time to repay. The other clause is the defeasance clause. Defeasance clause says when the loan is paid, or in other words, if the loan is defeated, once it's paid off, the lender must provide proof that the loan has been paid off. So in different states, there's different methods of proof, okay? In a mortgage state, the lender must provide to the borrower a satisfaction of the loan. So in those states that use mortgages, there is a satisfaction given to the borrower once their loan is paid off. Legal term, technical term, the mortgage satisfaction. In states that use deed of trust, remember when the loan was paid off, what did the trustee do with the deed? The trustee reconveyed title to the borrower. So the trustee gave the borrower a deed of reconveyance. Both of those, by the way, should be recorded by the borrower, so there's evidence that the loan has been paid off. Some other important clauses that you'll need to know for the test. Due on sale clause. otherwise known as the alienation clause. Due on sale clause simply says that if the owner of the house sells their house to a new buyer, before that loan is paid off, the loan is due and payable upon the sale of the house. It has to be paid off before the homeowner can transfer title to somebody else. Now, it's also referred to as the alienation clause because, and this might fill in some gaps in some of your other education, anytime a homeowner transfers title of their property to a new owner, that's called alienation of the property. So if I sell my house to you, we have a successful closing, in theory, I have alienated myself from this property and now you own the property. So alienation, if you think about it, is the same thing as selling or transferring the title. But that's why the due on sale is often referred to as the alienation clause. Second very important clause is the power of sale clause. Power of sale clause says that the lender can sell your house and foreclose upon your house without going to court. If you borrow money from a lender, remember, you're going to give that lender a mortgage. In the mortgage, it's likely going to say that if you default on that loan, you're giving the lender the power to sell your house if you default on the loan. So that's why the power of sale clause indicates that the lender can foreclose without going to court. Let's state that another way for your test. That's non-judicial foreclosure. So here's the dots I want you to connect. Power of sale clause means the lender can go to foreclose on your house without going to court. If they can foreclose without going to court, that's called non-judicial foreclosure. So the test question is likely going to be, Tom's lender foreclosed on him without going to court. What clause had to be in Tom's mortgage? And that's the power of sale clause. Or another term for without going to court was non-judicial foreclosure. So understand how that power of sale clause is going to lead to non-judicial foreclosure. Very important you know the difference between the primary mortgage market and the secondary mortgage market. Pretty simple, pretty straightforward. Primary mortgage market is where borrowers go to get money to buy a house. The secondary mortgage market is where lenders go to sell many of the mortgages they've made so they can put some money back in the bank and make more loans to other people. So secondary mortgage market is where lenders sell mortgages. Primary mortgage market is where borrowers go to get money to buy a house. Now we're going to discuss 3 different loan types. Very important you make some notes on these because I'll share with you how they're going to ask you the test questions and how these loans compare to each other. We've got an interest-only loan, partially amortized loan, and a fully amortized loan. Interest-only loan will also be referred to on occasion as a term loan or a straight loan, both the same thing, okay? The interest-only loan, think about the concept. I want to borrow $100,000, but I'm only going to pay interest on it for 5 years, and then I'm going to pay the whole loan off. So what happens with the interest-only loan? I borrow $100,000, I make interest-only payments for 5 years. How much do I owe at the other end? I owe the whole $100,000. So an interest-only loan has the smallest payment because I'm only paying interest. But it's also got the largest balloon because I owe the entire balance at the other end of the loan. Let's go to the bottom of the slide, a fully amortized loan. Easiest to compare with that one. Fully amortized loan, I borrow that same $100,000 from a lender and I pay for it over 30 years. I make payments every month on the interest and the principal. And if it's fully amortized, at the end of the 30 years, how much do I owe in principal? 0. It's all paid off. So a fully amortized loan is going to have the largest monthly payment, but basically no balloon payment, the smallest balloon or no balloon payment. So they're going to ask you on the test, how do the monthly payments and the balloon payments compare. I did the first one and the bottom one second. Let's do the middle one now. Partially amortized loan. Partially amortized loan is kind of a blend. This loan will, I've borrowed the same $100,000 from a lender, and the lender will say, make payments as if it were a fully amortized loan. We'll amortize the loan over 30 years, and you make payments just like you would on a fully amortized loan, but it's only a 10-year loan. So at the end of 10 years, now I have to pay whatever the balance is. So a partially amortized loan is going to have a very large balloon in the middle because I've only paid on it for 10 years and I haven't probably paid much principal down. So comparing the monthly payment with the balloon payment on these three types of loans will help you get 2 or 3 more test questions correct. Next loan type I want to share with you is the adjustable rate mortgage, only because there might be 1 or 2 questions about the adjustable rate mortgage. May or may not involve a calculation, but you want to have the information. An adjustable rate mortgage uses 2 pieces of information to determine the interest rate on the loan: an index and a margin. Index is usually a publicly traded number, information somebody could look up, like a treasury bill. And a margin is something the lender will typically come up with themselves, and they'll add the index to the margin to get your actual current interest rate. But most adjustable rate mortgages will have adjustment caps. Whenever the loan adjusts, usually every 1 year, it can only adjust a certain amount. It's a way to control how much it can adjust. And over the lifetime, they will limit how much it could overall adjust. So in our example, if a index for a loan right now is 4 and a margin is 2, that means the rate would be 6%. You add the 4 and 2. But what would happen, and it's going to adjust every year, but what would happen at the end of that first year if the index jumped to 6? The index jumps to 6, our margin was 2, so now the interest rate will be 8, correct? Wrong. Wrong, because it'll tell you in the test question, if the index goes to 6 and the margin stays at 2, that means the interest rate could be 8, but there was an adjustment cap of 1%. Can't adjust more than 1% per year. So instead of jumping from 6 to 8, the loan itself would limit the maximum interest rate you can be charged in that second year to 7. So watch for adjustment caps, lifetime and annual adjustment caps when you look at that, see that question on the exam. You're finding out that this financing episode has a lot of information, and we've got a lot more to go. So keep your notebook handy and take a look at this graph that I have on the screen. There's a lot of information packed in here. I want to review it with you quick, but if you can get a screenshot of this, take a picture with your camera, I'd recommend you do this because there's a whole lot of information that will help you on the test here. 4 different types of loans down the left-hand column: conventional loan, an insured conventional, an FHA loan, and a VA loan. So the second column says, is there any mortgage insurance on either one of these loans or any one of these loans? Well, with a conventional loan, there is no mortgage insurance. Why? Keep reading across the top. The borrower put 20% down, which means the loan to value was what percent? Because they always total 100%. With 20% down, the loan to value of 80% totals 100%, but the conventional lender told the borrower, if you put a minimum of 20% down, you don't have to pay mortgage insurance. So that's why the borrower put 20% down. So the next borrower comes along and says, I can't afford to put 20% down. I can only afford to put 5% down. Can they still get some sort of a loan? Yes. If they only put 5% down, what's their loan to value? Well, 95%. But with only 5% down, the lender shares with them, I have to charge you PMI. That's mortgage insurance. So here's a note I'd have you make. PMI stands for private mortgage insurance. PMI, private mortgage insurance. is going to be placed on loans where the minimum 20% down payment is not made. Or, stated another way, the loan to value is higher than 80%. They'll require PMI from a conventional lender, which means that loan will be referred to as an insured conventional. Well, next borrower says, I don't know, I'd rather get an FHA loan because I only have to put 3.5% down on an FHA loan. So in an FHA loan with only 3.5% down, what's the loan to value for that one? Well, that's going to be 96.5% because they total 100%. And does the borrower with an FHA loan and a 96.5% loan to value, do they have to pay mortgage insurance? You bet they do. Well, what's that called? Well, we have a different acronym for that. That's called MIP. That's called a mortgage insurance premium. So that's the big difference I want you to keep track of for the test in your notebook. MIP, mortgage insurance premium, is placed on FHA loans with a small down payment. But PMI also is mortgage insurance, but PMI is the term that's used when it's an insured conventional loan. In other words, a non-FHA loan or a non-government loan. Remember I said PMI on the second row there, it stands for private mortgage insurance. That's how you should be able to remember it. PMI is private mortgage insurance, not government mortgage insurance. So PMI is private, a conventional loan is a private loan. An FHA loan, I would refer to as a government loan. Government loans, FHA loans, have mortgage insurance premium. Or another buyer says, hey, good, well, you know what? I'm a qualifying veteran. I think I'll get my money and borrow my money with an FHA loan. I'm sorry, with a VA loan. With a VA loan. So if a VA loan is taken out, and they can get VA loans with as little as nothing down. So if the down payment is 0% on a VA loan, what's the loan to value? 100%. No down payment, they're going to borrow the entire 100%. Here's another note I want you to make in your notebook and get you through the test. If a borrower on a VA loan doesn't put anything down, do they have to buy mortgage insurance? The answer is no, they don't. Because the VA doesn't use insurance, the VA guarantees the loan. So remember the word association with a VA loan, that's guarantee. Think of guarantee being self-insured. They don't go to a third-party insurance company. The VA says if the veteran defaults, the VA will make the bank whole again. They'll reimburse the bank. So that's the whole key to my chart here, is that second column. On a regular conventional loan, mortgage insurance, nope, 20% down. On an insured conventional, is there insurance? Yeah, it's in the name, insured conventional. That's called private mortgage insurance, PMI. FHA loan, is there insurance? No. I'm sorry, FHA loan. Yes, there is insurance, and that's called a mortgage insurance premium. I jumped ahead. The VA loan, is there insurance on the VA loan? Terminology for the test, no, there's no insurance on the VA loan, but the VA does guarantee the lender not to lose money. So VA loans use a guarantee. Let's talk a little more about the FHA loan. This is a list of things that are going to show up on the test for you. They'll be on the test in the form of a question that says all of the following are true of an FHA loan. Which of the following is false of the FHA loan? So you need to know these factoids, if you will, about FHA loans. The money the borrower gets comes from an approved lender. What's the key there? FHA does not loan money. The money comes from approved lenders, which almost any lender out there can make FHA loans. So the money doesn't come from the FHA, the money comes from approved lenders. Who sets the interest rates on the FHA loan? Pretty much that question shows up all the time. Who determines the FHA interest rate on an FHA loan? Federal government? Department of Housing and Urban Development? No, the lender sets the interest rate. The lenders set their own interest rates. To get an FHA loan, the property must be owner occupied. You can't use an FHA loan to buy rental property. The FHA loan must include an escape clause. Grab your notebook. What's an escape clause? The escape clause says if the borrower can't qualify for an FHA loan, then the borrower can get their earnest money back and escape the purchase agreement. That's the escape clause. Borrower can get their earnest money back. There can be no prepayment penalty in an FHA loan. Well, what's a prepayment penalty? Well, some lenders used to charge a prepayment penalty. I'll loan you money for 30 years. I'm counting on receiving that money in a monthly payment over the next 30 years. And now you want to pay it off early in 10 years? That's going to cost me money and throw a wrench in my plans. So some lenders would charge a borrower a penalty to prepay their loan. FHA says not allowed in an FHA loan. These are all good points to remember for the test. Okay? And FHA loans that are made now are assumable. Somebody else can assume that borrower's FHA loan. But you might want to make this note about assumability of an FHA loan. Only if the new borrower qualifies. They have to qualify for the loan. And it is assumable. Here's a great list of information of things that are true about VA loans. You'll need to know these just like the FHA loans for the test. Which of the following are true? First of all, there's no insurance premium, but the buyer does pay a funding fee. It's a terminology difference. They pay money, but a VA loan, it's called a funding fee, not an insurance premium, because, item number 3, the VA doesn't insure the loans. The VA guarantees the lender from losing money. No down payment, 100% loan to value, we mentioned that. Also, no prepayment penalty on a VA loan. Cannot include a due on sale clause. Eligible veterans can be either active or retired military. And the home must be owner occupied. All of those are true of VA loans. Let's talk about seller financing for a minute. Some involved things here. I want to walk through these fairly quickly, but make sure you have a good feel for it. If you come to me and want to buy my house and I'm offering seller financing, here's one method we could use. I tell you, you give me a mortgage and I will give you the deed to the house. So you as a buyer have legal title after you've given me a mortgage. You also have to give me a promissory note. Remember, that was the IOU. So as the seller, what do I have? I have your down payment, I have a mortgage from you, and I have a promissory note from you, but you as the buyer have legal title to the property. And I also then, like a lender would do, I'll put a lien on your property. I'll put a lien on the property. That's what it says in the mortgage that you gave me. So I'll put a lien on the property. So what happens if you default on the loan? What happens if you default on your IOU and the terms? How do I get my property back? I have to foreclose on you. Whatever state you're in, whatever the laws of foreclosure on. So the link here is that if you use a mortgage to buy my property with seller financing, to get my property back, if you default, we have to go through the foreclosure process. For many sellers offering seller financing, that whole process and procedure using a mortgage can be very cumbersome and time-consuming. So most sellers would probably use something called a contract for deed. In your state, it might be called a land contract or an installment contract. You have to know the differences between the contract for deed financing and mortgage financing for the test. Now let's have you buy my house using a land contract or installment contract or contract for deed, whatever it's called in your state. All the same thing. You come to me and you give me some money, you give me your down payment, and we talk about the terms and the payment length of time and how much money every month. All of that's in our contract. But you give me a down payment, we both sign a contract for the deed, but I as the seller keep legal title. until the contract is paid off. So you've given me a down payment, we've both signed a contract, and I keep legal title until when? Until you pay off the entire contract, then you get legal title. One of the big differences, remember, if you bought my house using a mortgage, you got legal title up front. On a land contract or installment contract, I keep legal title until the contract is paid off. So I want you to look on my slide here. If I keep legal title, do you have any kind of title to my property when you buy it on a contract or a land contract or contract for deed? You bet you do. You have equitable title. And I want you to make a note in your notebook about equitable title. Remember that term for the test. I want you to think about equitable title this way. Equitable title I refer to as contractual title. You and I have signed a contract. I keep legal title. We have a contract for you to get legal title once the contract is paid off. So that means that once the contract is paid off, can I change my mind? Can I just say, oh, I'm not going to give you legal title now? No, you have contractual title. When that contract is paid off, I have to give you legal title. So that's called equitable title. You have enforceable or contractual title on the property, all right? So what happens if you default on the terms of our contract before it's up and you're not making the payments and I want to get my property back? Well, when there's a land contract involved or an installment contract involved and you default, I don't have to go through foreclosure. I terminate the contract. I want you to make a note of that word association. With a contract for deed or land contract, the remedy for default is termination. I can terminate the contract as the seller and get my house back a lot quicker. Remember the remedy for default if we used a mortgage, that was foreclosure. So there's some word associations you want to compare for the test. Buyer default on a contract for deed is termination. I know you covered reverse mortgages in your education providers classes. Let's talk about what you need to know for the test. Who uses reverse mortgages? Who were they designed to help and be of service to? Seniors. They'll ask you this on a question about reverse mortgages. Who pays who? Who pays who? Well, the bank pays the borrower every month instead of the borrower making payments. They're not going to say borrower and bank. What are they going to say? Mortgagee and mortgagor. So the mortgagee is the lender. The mortgagee is the lender. The borrower is the mortgagor. So if I want to borrow money on a reverse mortgage, I go to the bank and say, hey, look, I'd like to borrow money. I live in a house, it's paid for, $100,000 value, but I don't have enough money every month to pay all my bills. I'd like to get a reverse mortgage. The lender says, okay, let's put that together. So when I qualify for my reverse mortgage, maybe I borrow $80,000. The bank doesn't give me the whole $80,000 up front. I'm on the hook for $80,000, but the bank only gives me $1,000 a month for 80 months, let's say. What's the benefit to me? Well, I'm only incurring interest charges on the money I've taken out of the bank. So that's why it works well for seniors. And also true, excuse me, with a reverse mortgage is there could be some negative amortization. Remember those terms about reverse mortgages for your exam. Here's some other types of loans that might show up on your test. And I want to give you the basic differences with a quick comment about each one. A home equity loan. Home equity loan is you're going to borrow money against the equity in your house, but whatever you borrow, you'll take out in one lump sum. That's the key to a home equity loan, one lump sum. Because it's different than a home equity line of credit. I might have the same amount of home equity, but I might say to my lender, I want to set up a home equity line of credit, but I don't want to take out a big lump sum now. I might want to take out $500 or $1,000 or transfer some into my checking account whenever I need some extra money. So that's a line of credit. Construction loans basically used by builders as short-term interim financing to get a home built. Blanket loans allow for a developer to borrow money to buy a whole development, but then as they sell individual lots, they are able to get a partial release from their lender, pay off that one lot, and actually get a release from their lender so that that lot is not now encumbered by the overall mortgage. So think about a blanket loan and a partial release, a good word association for a blanket loan, partial release. And a package loan. A package loan is a loan that involves personal property and real property. Where are you likely to see package loans? That would be a test question, I believe. And you want to say resort condominium would be a good example. Come to my resort condominium complex, I'll sell you a condominium, and the condominium is furnished. So the condominium will be a total of $200,000, but that will include $50,000 worth of furniture. But you're going to pledge them both as security, the real estate and the personal property. I'll make you a package loan. So word associations for the test: package loan, real property plus personal property, and where are they likely to be found? Resort condominiums. We've got some more testable information here on RESPA. Remember the Real Estate Settlement and Procedures Act. What did it do? Why was it formed? It's standardized settlement procedures across the country. What does RESPA do? It discloses all closing costs. Buyers were surprised when they got to closings and said, oh, I didn't know I don't owe this extra money. Now all has to be disclosed up front. It prohibits kickbacks, but it also does allow rebates. And if you want to make a note about rebates, rebates are only allowed to be made to your current client. If I sell a house to a buyer, and at closing, I say to that buyer, you know, I told you that if you bought a house from me, I'd give you $1,000 back out of your costs at closing. I can rebate to my buyer whatever I want to on that transaction. Not for a different transaction. That's what will be on the test. Not for a previous transaction, not for a future transaction, but to a current transaction. You're allowed rebates. The Truth in Lending Act, TILA, refers to more disclosures that need to be made in the marketplace. First of all, Truth in Lending Act deals with lenders. Truth in Lending Act just deals with lenders. The lenders have to disclose what the APR is. APR, if you recall from your coursework, is the actual cost of borrowing money, not just the face rate of the loan. If I get a loan rate of 6% and then the lender charges me other costs, is my total cost of getting that loan higher than 6%? Yes, lenders have to disclose that. So here's the key point. Lenders must disclose the true APR, and that APR will always be higher than the loan rate. So if I get a 6% loan rate, my APR is always going to be higher because the APR includes the loan rate plus the other costs. So that's always a true statement to look for on the test. And the Truth in Lending Act said borrowers have a 3-day right of rescission. After they sign a loan agreement, they have 3 days to rescind that loan agreement. But there's a big key at the bottom of the slide. I want you to make a note in your book about that. There is a 3-day right of rescission on what types of loans? Home equity loans and refinancing loans. They have a 3-day right of rescission. But what type of loan does not have a 3-day right of rescission? Home purchase loans. Remember that for the test. Easy one to mess up on. Home purchase loans do not have a 3-day right of rescission. You'll always have a question or two about TILA and Regulation Z. Regulation Z is the advertising regulation. What are you allowed to advertise in your real estate ads without triggering a full disclosure about the property and the financing? You're only allowed to advertise the price and the annual percentage rate. Remember the higher number, higher than your face rate of the loan. those two things. You'll need to know for the test what things would trigger the need to make full disclosure in the ad. So you've got a list of them there. Percentage of down payment, that triggers a full disclosure in the ad. The amount of payments, number of payments, time period of the payments, finance charges, interest rate of the loan, any of those would trigger the necessary full disclosure. So make sure you understand what the triggers would be to mandate full disclosure in an ad. Boy, we in real estate love our acronyms, don't we? We have so many acronyms, it drives me crazy, and I do remember taking my test, drove me crazy then. But here's some new ones. TILA, Truth in Lending Act, was combined with RESPA, Real Estate Settlement and Procedures Act, in a new integrated disclosure called TRID. So TRID is TILA, T is TRILA, R is RESPA, and then integrated disclosure. So what's in TRID? They renamed some of the real estate forms. You'll have to know what these names are, these newer forms. So loan estimate. Loan estimate comes from your lender. You apply for a loan, the lender has to give you a total loan estimate with all these disclosures. When does the lender have to give you that loan estimate? This is a testable date. 3 business days after application. The lender must send you the loan estimate. The other form that's very important is called a closing disclosure. That has all the debits and all the credits from both buyers and sellers. It lets you know what's going to happen at the closing table. And that has to go out to all the parties to a transaction when? 3 days before closing. In other words, nowadays buyers and sellers got to have 3 days to look this document over before they walk into the closing. Designed to prevent some high pressure tactics at the closing itself. So loan estimate, 3 business days after application, closing disclosure, 3 days before the closing takes place. Okay. I mentioned ECOA a while back. ECOA, the Equal Credit Opportunity Act. ECOA adds age as a protected class, age and public assistance. But age is the one that gets confused on the test with the federal fair housing protected classes. So age is only a protected class under ECOA. And additionally now, lenders have to provide written information if they turn a borrower down for a loan. They have to send that potential borrower a letter about why they were denied the loan. You'll probably see a question or two about short sales on your exam, so follow me on this list, some information to look for in the exam. Why do short sales take place? Well, the market value of a property is insufficient to pay off the outstanding loan balance. Maybe because of market conditions, true in the not too distant past. My house is now only worth $200,000, but I still owe $250,000. I might want to call my bank and see if they'll allow me to do a short sale. That means, would the bank allow me to sell the property for whatever I can get, and whatever I get, the bank would accept to pay off my outstanding loan. So the bank may or may not agree to that. Lenders may or may not agree. That's up to the lender. If they do agree to it, as a seller, I still may have to pay that deficiency. I still may have to pay off the amount of money I still owe the lender, even if I sold my house for less. The lender is on the hook for the rest of the money. So they might tell me I still have to pay the deficiency. Or the seller might have tax consequences. What if my seller was very nice and said, you owe us $250. You sold your house for $200, and they said they'll accept it, and now they let me off the hook for the loan. In some instances, in some states, the IRS might come knocking on my door and say, the bank just gave me a $50,000 gift, and the IRS in the past has at times considered that income. And now I have to pay income on the amount that the bank let me not pay. Okay? So these are all things that are true about short sales. They might phrase those in a test question a couple of different ways. I want to follow up on a couple things about foreclosure before we're done with this session. We talked earlier about judicial foreclosure versus non-judicial foreclosure. If you take a look at non-judicial foreclosure first of all the rules follow state laws. We don't talk much about foreclosure here because it's basically on a state level. However, you do need to know the difference between judicial and non-judicial foreclosure. And I went through that a little bit earlier. In the bottom now, non-judicial foreclosure. If the mortgage I gave to my lender included a power of sale clause, that means I gave my lender, when I borrowed the money and gave them the mortgage, I gave them the power to sell my house if I default on the terms of the mortgage and the promissory note. Okay? It's also the same thing with deeds of trust. So that's non-judicial foreclosure. Some instances when borrowers borrow money and give their lender a mortgage or a deed of trust, it doesn't contain the power of sale clause. That means that lender would have to go to a judge, convince the judge that I'm really a bad person and they should be able to foreclose on me and start the foreclosure process. All of those rules follow state laws, but here's a question you'll likely see. Tom's lender foreclosed on him without going to court. What clause was in the mortgage Tom gave his lender that allowed the lender to foreclose without going to court? Power of sale clause. Although most foreclosure laws follow state laws, there are some commonalities and common elements between foreclosure laws, and these are the ones that will show up on your national test, okay? A borrower would likely always have a chance to reinstate the loan, which means make up all the past payments. If they're in default, make up all the past payments and make the bank whole again, so they can get it reinstated. Some states allow the borrower to redeem the loan after the sheriff's sale. Some states don't have a redemption period after the foreclosure sale. Some states do have a redemption period. That's all based on state laws, okay? Otherwise, there is a sheriff or foreclosure sale that the high bidder will likely be able to obtain title to the property. If I'm the high bidder at a sheriff's sale, in some states, if I'm the high bidder, the sale is over, the sheriff says, here's the keys, you own the property. Other states who have redemption rights for the borrower, in those states, I'm the high bidder at a sheriff's sale. The sheriff says, good, give me the money. Your borrower has 6 months to redeem the property. If they don't redeem it within 6 months, then you get the property as the high bidder. So I might not get the property right away. If the borrower does redeem and I don't get the property, even though I gave the sheriff some money at the sheriff's sale, what happens to my money? I get it back. I get it back sometimes with interest, all depending on state laws. Well, that wraps up the financing video. I know there's a lot of information in there, and it's because there's a lot of questions on the test about financing. So I'm trying to be as helpful as I can, but here's a list of my other national topic videos. If you want to take a look at those, review any of those before you take your exam, please do. Thank you for watching this video. I appreciate it. And stay focused, stay positive out there. I know you can do this. And as always, if you like the video, hit like. If you want to subscribe to my channel, I'd be happy to send you updates when I include other information and other videos on my channel. I've got a career prep series coming out, and I've got a skills prep series coming out. Things to think about after you pass your exam. As always, I'm open to comments, and if you know somebody else who's in the process of taking their real estate exam soon, please feel free to share this video with them. Thank you.